Hello, everyone. Before I begin, I'd like to thank International Institute of Academic Research and Publications for giving us the opportunity to present this paper entitled Self-Efficacy and Risk Tolerance of Stock Investors. My presentation will be divided into the following sections. You have the biography, abstract followed by description, conclusion, and then the appendix. To begin with, I'm Siegfried Erorita, and I obtained my degree in Bachelor of Science in Accountancy from Baguio College's Foundation. I obtained my master's degree in Business Administration and PhD in Management, both from the University of the Cordilleras. I am a practicing CPA, and currently I'm also a faculty member at the College of Accountancy under the BSA program. I also teach in the College of Business Administration in the MBA and PhD programs and under the College of Information and Computer Sciences in their MIT program. My specializations include advanced financial accounting and reporting, managerial accounting services, and financial management. And my current research interests are financial decision making and analysis, financial operating performance, and behavioral finance. The main purpose of this study is to determine the relationship of self efficacy and risk tolerance of investors together with their gender, age, education, marital status, income, net assets, and source of income. It was conducted to provide a deeper understanding of their investment behaviors, which can serve as a guide in making the first step in portfolio management, enterprise resource management, and financial risk management. In this paper, self efficacy is defined as a psychological construct which pertains to one's personal assessment or beliefs of their abilities, which in turn informs them of their course of action to take. Also, in this study, risk tolerance is defined as the degree of variability in investment returns that an investor is willing to withstand or absorb. In making sense of a person's willingness to accept risk, self efficacy can provide a springboard from which to start understanding his financial aptitude, specifically how this self efficacy could potentially propel him to brave financial risks. Self efficacy is a truly powerful tool in shaping one's overall self image and in effectively producing specific behaviors to attain one's goals. This study therefore sought to reconcile these two interdisciplinary concepts into a woven mechanism of smart investment management. It sought to find out whether a significant correlation exists between self efficacy and financial risk tolerance among selected stock investors in the city of Baguio. This study includes the following problem. First, what is the level of self efficacy of the respondents, followed by the correlation between the respondents' self efficacy and gender, age, education, marital status, income, net assets, and source of income. This is again followed by the level of risk tolerance of the respondents and the correlation between the level of risk tolerance of the respondents and the above mentioned variables. Finally, we are going to answer the question, what is the correlation between self efficacy and risk tolerance of the respondents? Data to answer these research problems were obtained using two questionnaires, one that measured self efficacy and another to measure risk tolerance. Descriptive correlational approach was used as the research method, while purposive sampling was used as the sampling method in obtaining the participants of the study. Stock investors residing in and around Baguio City were the main respondents. The statistical tools used for the data were the weighted mean, point by serial correlation, Pearson's contingency coefficient, and Pearson's product moment correlation coefficient. This table shows the profile of the respondents. As you can see, they are classified into, well, as to sex, we have male and female. For age, there are 5 classifications. For education, there are 4, from those who did not finish high school up to those who were able to obtain their postgraduate. For marital status, we have the married and the unmarried. For income, they are classified into 5 categories. For source of income, there are 4, and for net assets, there are 5 categories. Feel free to pause the video if you are interested in this classification found in this table. Moving on, we have the following results and discussion. For problem 1, we found out that the stock investors of the city of Baguio have a very high level of self-efficacy. They scored an overall weighted mean of 3.21 in a Likert scale of 1 to 4 in the self-efficacy scale of Shear, Maddox, Mercadante, Prentice Dunn, Jacobs, and Rogers. This means that on the average, the respondents have a strong belief in their own abilities to produce certain actions or accomplish certain tasks. This table shows the correlation of self-efficacy and the 6 moderating variables. And from this table, based on their coefficient and the level of significance, we can say that only age, income, and net assets significantly correlate with self-efficacy. With age, the older a person gets, the lower the self-efficacy level. However, for the respondents of this study, none of them actually scored low in the self-efficacy scale. But the implication is that age may temper one's assessment of one's abilities, making them more realistic and grounded than younger people who are often more ambitious and idealistic. Income and net assets have a low to moderate but positive relationship with self-efficacy. Since correlation does not mean causation, it could be that high self-efficacy influences one's ability to accumulate wealth or vice versa. As for sex, educational attainment, marital status, and source of income, the respondent's self-efficacy do not necessarily relate to any of these variables. This table shows the level of risk tolerance of stock investors, and with an average of 85.01, they belong to the moderate to speculative category. This means that on the average, these investors can withstand losses of up to 15%. They invest less in investment with steady income and more with growth investments. And like cautious to moderate and moderate investors, moderation in all things is the statement that can best describe their feelings about investing. This table answers problem number 4. It shows the correlation of risk tolerance to the 6 variables. And from their coefficient and the level of significance, we can say that age has an inverse relationship with risk tolerance, such that as one gets older, the less tolerant they become of financial risk. Income, net assets, and source of income all have positive relationship with risk tolerance, such that as one accumulates more wealth, the braver they become in investing their money. This is a clear manifestation of financial management's first axiom, which is the higher the risk, the higher the return. Furthermore, these variables also determine the extent of losses they can absorb, which further translated to higher risk capacity. For sex, educational attainment, and marital status seem to be irrelevant to one's propensity to tolerate financial risks through investments in stocks. Finally, we have this table which shows the correlation of self-efficacy and risk tolerance with a value of 0.759, okay, and a significance level of 0.000. This means that there is a definite relationship between risk tolerance and self-efficacy. This positive coefficient means that as the risk tolerance of the respondents increases, their level of self-efficacy also increases. It may also mean that the respondents' level of self-efficacy influences their level of risk tolerance to a high extent or vice versa. For the conclusions, as to the main variables, stock investors of the city of Baguio have a very high self-belief. They have moderate to speculative level of risk tolerance, and that the higher the level of self-efficacy, the more tolerant the investor on the risk involved in risk or in stock investment. In other words, a stock investor's chances of becoming successful in managing their investment and wealth building is supported by their healthy disposition, positive outlook in life, and a sound belief in their own abilities. Now, as for the six variables, age has an inverse relationship with self efficacy and risk tolerance. It is then best to start young when it comes to building one's portfolio. Sex, education, and marital status do not have a relationship with both self efficacy and risk tolerance. These societal labels should not be sources of double standards as to who should excel in life. Whether one is male or female, a diploma holder or not, and whether one is single, married, or widowed, each person has the potential to advance financially. One source of income does not have any relationship with their self efficacy level. And it's not where money comes from, but what one does with it, no, that counts. So it's more like the talent story, no? It's not where your talent came from, but what you do with the talent given to you. Anyway, moving on. Income and net assets positively correlate with self efficacy. It takes strength of character to maintain a healthy relationship with money. Income, net assets, and source of income positively correlate with risk tolerance. As expected, prior experience of economic achievement informs a person better of how to consequently manage their succeeding cash inflow. And that's all for my presentation. We have the following appendix. Okay, this data is available and uploaded in Zenodo and Dryad repository. Also, the author declares that there are no conflicts of interest involved in the writing of this paper. And these are the following references. Once again, I'd like to thank everyone for your time and for your attention.